Welcome to Crypto 101, a first principles jargon-free course on blockchain and its impact on financial services. We are in the process of learning how cryptocurrencies mimic the properties of fiat money. We are currently focused on the property of transferability by which fiat money is transferred from one account to another. In the previous lesson we learned about how payments are initiated in cryptocurrencies. In this lesson, we will complete the discussion on payment initiation. We will begin with defining custody. We will learn how custody is exercised in crypto assets through private keys. We will then learn about custodial and non-custodial wallets. Finally, we will review how the method of exercising custody of crypto assets impacts the payment initiation process. Before we proceed further with this lesson, let us orient ourselves on where we are in this course. We have been learning about how cryptocurrencies mimic the four properties of currency. The property that we are currently focused on is transferability. In the previous lesson we learnt that cryptocurrencies are transferred via the three steps of initiation, authentication and value transfer. We covered initiation in the previous lesson and we will conclude the discussion on payment initiation in the current lesson. This is a good time to make a brief detour to understand what is meant by custody of a financial asset. Imagine you have 100 shares of Apple in your brokerage account. Your financial advisor instructs your brokerage firm to transfer these shares to his account. Your brokerage firm will hopefully not follow his instructions because it has custody over the assets. Custody of financial assets refers to the responsibility of ensuring that the ownership of the asset is not transferred to an illegitimate owner. Custody and ownership are thus closely related. The function of custody is to prevent loss of ownership from theft. Ownership of a financial asset is proven in two ways. One is physical possession. For instance, physical possession of currency notes or a money order that is payable to the bearer is sufficient to prove ownership. However, in modern finance this is uncommon. The second method is more common. Ownership is recorded in a register by a trusted record keeper. For instance, a bank records your ownership of cash in a bank account. A brokerage firm records your ownership of shares and bonds. Consider Alice, who has $100,000 in her bank account. Tom manages to get her debit card and PIN, and steals money from Alice's account. But while Tom steals the money, he will not be recognized as the registered owner of the assets in the bank account. This is because physical possession of the debit card does not make Tom the owner of the bank deposit. This brings us to the distinction between bearer and registered forms of assets ownership. The bearer form means that ownership of the asset is evidenced by the possession of a physical or digital artifact. An example is a cashier's check, which is payable to the bearer of the check. A digital equivalent is a virtual prepaid card. The registered form means that ownership is evidenced by inclusion of the owner's name in a register that is recognized to be the source of truth. An example is a motor vehicle title. If someone stole the title document, she would not own the car until a public agency recorded the change of ownership in its database. Similarly, as we just discussed, physically holding a debit card does not mean that debit card holder is the owner of the bank account. Over time, the share of the bearer form in financial assets has declined. Somewhat counterintuitively, the proof of ownership of crypto assets follows the bearer paradigm. There is no register of crypto asset owners in the blockchain. The person who knows the private key to a blockchain address effectively owns the assets held in that blockchain address. We define custody of financial assets as the responsibility of ensuring that the ownership of the asset is not transferred to an illegitimate owner. We can simply substitute financial assets with crypto assets and the definition still stands. Since there is no ownership register, custody of crypto assets effectively means knowing the private key. The owner of the crypto asset is the individual who knows the private key. This form of attributing ownership is equivalent to the bearer form of financial assets. The custodian of the crypto asset is the individual who knows the private key. Hence, the owner and custodian were designed to be the same in the original vision of the blockchain. We can refer to this as self-custody. Self-custody of crypto assets means the asset owner must maintain secure records of the private key. However, this is difficult for most people because of two reasons. First, private keys are long, non-intuitive and difficult to remember. Second, asset owners can have multiple blockchain addresses and private keys. In this lesson, we will learn some of the approaches by which the record-keeping of private keys is made easier. Let us recap a learning from the previous lesson on the two approaches by which individuals can transact in cryptocurrencies, direct and intermediated. In the direct approach, the individual making or receiving crypto payments runs a node on the blockchain network. This requires a level of technical proficiency that is beyond most people and is a barrier to mass adoption. In the intermediated approach, end users connect to the blockchain via one or more intermediaries. The inconvenience of managing private keys exists in either approach. Within the intermediated approach, there are two options for managing private keys, the custodial and non-custodial methods. Next, we will review what these terms mean. We can use an analogy to distinguish between the custodial and non-custodial methods. Imagine a locker at a bank which holds your family's precious jewelry. A custodial wallet is equivalent to the bank holding the physical key to the locker. In the non-custodial method, you choose to hold the key to the locker. We can also refer to the non-custodial method as self-custody since the owner of the asset is exercising custody of her own assets. In the custodial method, the holder of the crypto asset lets the intermediary maintain the private keys. The intermediary is the custodian of the crypto assets because it holds the private keys of the blockchain address where the asset is held. In the custodial method, the ownership of the crypto asset is decoupled from the custody. The owner of the crypto asset is maintained in the registered form by an intermediary. The custodian of the crypto asset is the intermediary. Next, we will review an example. On the screen I open an app of a well-known fintech. This app provides many services, but for now we are only focused on Bitcoin. I open the Bitcoin wallet component of the app. You can see that I have an auto-invest feature set up whereby I have instructed the app to buy $50 worth of Bitcoin every week. The blockchain address where the Bitcoin is held can be seen here. I can transfer the Bitcoin to another blockchain address by going to the screen. The private key to the blockchain address is held by the fintech on my behalf. I don't have custody of the private key. In fact, I don't even know what my private key is. The login credentials of the intermediary resembles traditional banking and is sufficient for the crypto asset holder to transact. In the crypto world, there is a saying: not your keys, not your coin. While custodial wallets may be satisfactory for a vast majority of people, some people have a strong preference for owning their own private key. Building on the parallel of valuable family jewelry being held at a bank's locker, self-custody would mean that the owner of the jewelry holds the key to the locker. A non-custodial wallet is a software application where the wallet company does not know the private keys and hence cannot transact on the asset holder's behalf. Put another way, the crypto asset owner has self-custody. The private keys and associated seed phrases reside in the hardware of the wallet user. The wallet company does not store the keys or the seed phrase in its systems. Earlier in the course I had demonstrated how I downloaded a wallet app called Exodus onto my computer from the internet. This was a non-custodial wallet. Let us go back to the example of precious family jewelry, where the owner of the jewelry chose to hold the key to the bank locker. If the owner lost the key in the bank locker scenario, there is likely to be an onerous identity verification process, by which he could get a replacement from the bank. But in the crypto world, if the asset holder loses the private key, she loses access to the asset forever. If I am not comfortable holding cryptocurrency in my custodial wallet, I can transfer it to my non-custodial wallet. I open the app of the fintech holding my non-custodial wallet. Note my Bitcoin balance of about $2,100. I go to the Send Bitcoin tab. I first enter the amount I want to send. I enter in the amount in US dollar equivalent. I enter the Bitcoin address whose private key is held in my non-custodial wallet. You can see that I have 3 different fees options depending on the speed with which I want to send. We will discuss the question of fees in a later lesson. I now approve the payment. As a next step, I can confirm that the Bitcoin I sent from my custodial wallet is received in the blockchain address whose private key is held in the non-custodial wallet. We can see the transaction that was received. The $20 that I sent has reduced somewhat because of change in Bitcoin's price. This is because about 25 minutes elapsed between the time Bitcoin was sent and this screen recording was taken. Next, I am going to take the transaction identifier of the payment I just made into my non-custodial wallet and search for it in the Blockchain Explorer. Now, we see something strange. The UTXOs on the left total nearly $68,000. But the balance displayed on my fintech app was only about $2,100. So how can I have unspent transactions totaling $68,000 in my account if my current balance is only $2,100? Further, they are being sourced from 4 different addresses. There are also 209 outputs, only one of which was the $20 I sent to the Bitcoin address whose private key was held in my non-custodial wallet. So, what is happening here? Next, we will explain the discrepancy. Custodial wallet providers may hold the Bitcoin of thousands of customers in one or more omnibus addresses. Hence, when I saw $2,100 was the Bitcoin balance on my account, it was just my share of the UTXOs on an omnibus address. This is similar to fiat money balances on gift cards or digital wallets like PayPal. The underlying money is usually stored in an omnibus bank account. The reason I saw so many UTXOs and so many outputs is because multiple omnibus addresses are impacted. In a custodial wallet, we can have two types of addresses. First, an omnibus address which commingles cryptocurrency holdings of multiple account holders. The private key to the address is held by the custodial wallet provider. Second, segregated addresses where each customer of the custodial wallet provider is assigned a different address, though, even here, the associated private keys are held by the custodial wallet provider. Note that on the blockchain network, an address is simply an address. There is no distinction between omnibus and segregated addresses. We can now see the inherent tension between the original vision of the blockchain that envisioned no central parties versus the convenience offered by central parties. An individual who wants to hold, buy and sell cryptocurrencies can operate on a continuum. As we move from left to right, decentralization decreases but convenience increases. On the extreme left is the direct approach option of running a blockchain node. The individual has self-custody of the assets. For convenience, the individual may use a hardware wallet, in conjunction with the Bitcoin node, to store the private key. On the extreme right is the intermediated approach of holding the private keys with a custodial wallet provider. In the middle is the intermediated approach of holding private keys with a non-custodial wallet provider. When people talk of the anonymity of blockchain, they are referring to the direct approach. No one needs to know who is running the Bitcoin node. Neither the Bitcoin software or the hardware wallet is aware of your identity. At the other extreme, the onboarding process of many custodial intermediaries represents traditional banking. For instance, the intermediary may ask for identity documents like a driver's license, similar to what banks do. In the intermediated approach, the degree of anonymity is dependent on the regulatory framework within which the intermediary is operating. How does a crypto asset holder choose the degree of intermediation she is willing to accept on the continuum that we just observed? The answer depends on many factors. One obvious factor is the technical proficiency of the asset holder. Another determinant is the purpose. An individual who is holding crypto assets for investment purposes and is willing to pay taxes on any trading profits may not have any incentive to remain anonymous. The value of the holdings could also determine a person's choice. Someone with millions of dollars in crypto asset holdings may want full custody with cold storage of private keys. This brings us to the end of this lesson. In this lesson, we completed one of the 3 steps by which cryptocurrencies are transferred between parties, namely initiation. In the next lesson, we will cover authentication and value transfer. Please review the summary of this lesson before proceeding to the next one.